Alrighty, good afternoon, everyone. Thank you for joining us this week at the Delray Beach Chamber of Commerce for our weekly webinar. We are super excited that we have Ms. Audra Wilson from WATS CPA today to discuss the top 5 cash flow management tips for business owners. And before I turn it over to her to get started, I just want to let you know that if you arrive late or you have to leave a little bit early, please don't worry, because this is going to be recorded and uploaded to the Chamber YouTube page, the Facebook page, and our webinars tab. So at this time, I'm going to go ahead and turn it over to Audra.
Thank you so much. And thanks again for having me. Very excited whenever I do have an opportunity to present for the Chamber of Commerce. All right, so I'll get started. So I'll go through my presentation and then we'll do a short Q&A at the end. Okay, as I mentioned, my name is Audra Wilson Russell. I am a certified public accountant here in the state of Florida. I established WATS CPA in October of 2012. I have a bachelor's of accounting degree from Florida State University, as well as a master's in business administration from Lynn University. I am an advanced certified QuickBooks Online Pro Advisor, as well as a certified advisor for Zero Accounting. And I am a member of the Delray Beach Business Partners Leads Group. And today, we're going to go through the top 5 cash flow management tips for small businesses. And what's on the agenda, I just did the about the presenter. So we'll talk about meeting with your CPA, understanding your cash flow, how to create and track cash flow projections, utilizing accounting technology to collaborate with your CPA, and then also implementing different strategies to increase your net profits. And then I'll give you a little bit more about my business at WATS CPA and the services we provide, and then we'll jump into the Q&A. Okay. Number 1 tip is to meet with your CPA. According to data from the Bureau of Labor Statistics, about 50% of small businesses fail within the first 5 years. Hire a trusted CPA to help you navigate cash flow for your business. So one of the main reasons to meet with your CPA would, of course, to be target setting and goal setting. So you have this business. There are certain things that you want to do with this business. Working with the CPA will help you stay on track to accomplish goals that you set, and look at how you're doing compared to your market and your competitors and things like that. So one of the things that you may want to track is your revenue. So is there a certain amount that you want to gross each year? Is there like an industry norm depending on what market you're in or what type of product or service you sell? So projecting out, what those goals are for the year. Is it a percent that you want to increase year over year? Or is it a specific dollar amount that you would like to reach for the upcoming year? Another goal would be to target on the gross profit. So once you've decided where you would like your revenues to fall, now you'll have that conversation with your CPA about what gross profit you would like to obtain. So after you've reached your revenue targets and you subtract all your costs that's directly associated with that revenue, what gross profit percentage would you like to carry on your books? Would you like to operate at like 40% gross profit or 30% gross profit? So that's one of those conversations that you would have and track with your CPA. And then also number of customers. If you're in a business where the more customers you have equates to more revenue, then you may want to use customers as one of those key performance indicators, or KPIs as we call them in the industry, to really focus and track how many you get in front of, how many you close, from the start to the finish, all the way from that first phone call to the consultation to the proposal to the closing of the invoice. And then also, one thing to look at would be your cash reserve balance. So once you are up and running and your business is bringing in a profit, at some point you will begin to set aside what I like to call a cash reserve for typically 3 to 6 months. But we see how COVID-19 is going right now. So I would actually encourage businesses to set aside cash for longer than that 3 to 6 month period, perhaps 12 to 18 months in the case of hard times. But those are the types of conversations that you would need to have with your CPA on the specific needs in managing cash flow for your business. Second tip would be to understand your cash flow. So once you begin meeting with your CPAs and you're having conversations about what targets you would like to achieve, now let's take a deeper dive into understanding exactly what cash flow means. In this case, your net income does not equal your ending cash balance. So a lot of businesses get hung up on at the end of the year when it's time to file their tax return. Well, they'll see a huge profit from the business, but the bank account is a little bit low. So let's delve in why that would be, why your net income doesn't necessarily equal your ending cash balance. All right, so to get there, let's first dissect what net income is. Your net income is just simply your revenues minus all of your expenses to come to what's called your net income. This is also your profit and loss statement. So on your P&L, you have all your revenues generated from the sales of your service or your product or, whatever. And then your expenses associated with selling those products or your cost of goods sold. And then also your operating expenses, things like your rent, your utilities, accounting fees, legal fees, marketing, all of that stuff. And then once you subtract all those expenses from your revenue, you arrive at your net income. Now, what is your net cash? Your net cash is what's found on your statement of cash flows. I know oftentimes we don't focus on the statement of cash flows as much as we focus on the profit and loss statement and the balance sheet, but the statement of cash flows kind of ties both in together so that you know where your money is going. So let's take a look at the breakdown of what makes up your net cash. It's your beginning balance, your beginning cash balance. So let's say you just started out operating, you deposit 5,000 into the bank. So your ending cash would be that 5,000 plus or minus any cash flow from operations. So what does it take to actually run your business? And then plus or minus any cash flow from investing into your business, and then plus or minus any cash flow from financing into your business. And we'll go over some examples of the types of operations, investing, and financing cash flows. And then this would equal what your ending cash balance would be at the end of that particular period. So here's an example of the statement of cash flows. Again, you'll start with that beginning cash balance and then plus or minus any cash flow from operating activities. Again, your operating activities is going to be the engine of your business. What runs the business? Of course, your sales, your expenses like rent, your employees, your supplies, your legal fees, your marketing fees, your accounting fees. all the fees that it takes to actually run and operate the business. And those expenses are typically found on your profit and loss statement. Then we look into the investing activities, which are typically found on your balance sheet. So, buying and selling of assets such as property, plant, and equipment. So, any new equipment that you're investing in, if you're investing in software for your business, vehicles, computers, furniture, equipment, this is all investments that you're making into your business that's typically, as soon as you buy it, doesn't necessarily go on your profit and loss statement. It goes onto your balance sheet. And then these types of expenses are what's called depreciated over a period of time. I know that with some tax advantages out there, you can immediately write off the majority of this stuff, but the proper accounting for it goes on the balance sheet first to show that it's an asset that's owned by the business, and then it gets written off over time in the form of depreciation. And then within the next section of your cash flows is any financing activities. And this could be any debt that you take on. Let's say you get a loan, a small business loan, because you need to infuse cash into your business. You would do that in the form of a loan from a bank, and that would be part of the financing activity that would increase your cash balance. And then also dividends or distributions from the company. So if you are a C corporation, it would be dividends that you're paying to the shareholders. If you are an LLC or an S corporation, just taking money out of the business, then that would be considered an equity distribution. You taking money out of the company, or an equity contribution, you pumping your own personal money into the company. Those types of activities are found within the financing activity section of the balance sheet. So, with all of that going on, you could have your beginning balance plus and minus your operations cash flow, plus and minus your investing cash flow, plus and minus your financing activities to arrive to what your ending cash balance would be. And so, let's talk about the tax treatment of it. So, from your business, you're taxed on the net income and not on the ending cash balance. So, although your net income could be a lot higher, your net income typically is a lot higher than your ending cash balance. And so, let me give you an example here. Let's say, and for simplicity reason, I'm using very small numbers here. So, in one instance, you have sales of 10,000 for the year. Very small. We're using very small numbers here. Your rent, 2,500. Both of those items that would go on your profit and loss statement. Your utilities of 1,400, profit and loss statement. So now where it gets a little tricky is the financing activities and the investing activities. They do not go on the net income statement, so it does not affect your taxes. They go on your balance sheet, which affects just your ending balance and the balance sheet. So any distributions that you take out of the company, not in the form of payroll, but just you taking money out of the company, would go onto the balance sheet, and it will decrease your cash balance. Any loan payments that you make. So let's say you did take out a loan and now you're making payments. Those payments that you make, they are not considered oftentimes I'll see this incorrectly coded in people's accounting as loan payment expense. There's no such thing as a loan payment expense. What is deductible associated with the loan is the interest payments on the loan, but the principal is actually a financing activity. So it decreases the ending cash balance through the balance sheet. So with all that being said, you can have 7,100 of net income, but your ending cash balance is only 1,650. When it comes for tax purposes, purposes, you're being taxed on the 7,100 of your net income and not the 1,650 of your ending cash balance. Number 3 would be to create and track cash flow projections. 29% of businesses failed because they ran out of cash, and that's from CB Insights analysis. So, what are cash flow projections? It's pretty much your cash balance, that beginning cash balance, and then you're tracking all of the money coming into the business and all of the money going out of the business. It's what's left. So, not a profit and loss or not the net income, but we're looking at every single dollar, whether it's a balance sheet item or a profit and loss item. We're looking at all the money that came in and all the money that went out. And so one of the reasons to track cash flow projections would be to answer some of those harder questions or make some smart business decisions. Can you cover your overhead for a particular period? Can you pay yourself? And longer term, is there cash available to invest in the business? So creating that cash flow for projection will help you look into the future. So similar to a budget, where a budget, you kind of sit down and you determine what your targets will be for the upcoming year. You know, you want to spend at least X amount on rent, X amount on utilities, X amount on marketing, and then you set a budget, and then you work towards not exceeding that amount or staying within that limit. That's a budget. But when it comes to projections, it's a little bit different, because now you're kind of controlling the future of how you're going to meet that budget, if that makes sense, and then make adjustments as you go. So an example of a very simplified cash flow projections, we're looking here at just the inflows. So in this example, ABC Company forecasting as of January 13th, we have a $5,000 beginning cash balance. And in this example, it's a weekly cash flow. So you'll see January 14th through the 18th, the 19th through the 25th, and so on. So for the next 4 weeks, we're looking at 5 clients paying $63,000 or collecting $63,000 from these 5 clients during the week of January 14th through the 18th, and then no cash collections for the next week. So this is going to be very specific to your type of business and how you collect money. This looks more like a subscription-based type of business where client payments are due once a month during a certain time of the month. But of course, every business is different. So you may have something every week, depending on what product or service you sell. And of course, the amounts may vary. And so this is the outflows associated with the projections, and very dense shortened list here for illustration purposes. So you will look at all of your outflows and look at what time of the month they would come out. So if we go back to that previous example, you see these are the these are the weeks that we're projecting the cash flow, the cash inflows, and then these are the weeks that we're projecting the cash outflows. So in this particular example, this company has utilities, landlord, more utilities, car payments, that kind of stuff, payroll. Payroll, as you see here, is every 2 weeks. And then all other vendors, I just threw that in there for calculation purposes. But of course, you would have a lot more expenses than the ones listed here. So week to week, when we're looking at week 1, the cash inflows was 63,800, and the outflows was only 10,500. So you have a net cash inflow of the 53,300. plus the 5,000 beginning balance where we started here. So then that will give us an ending cash balance of the 58,300 for week number 1. And so what you would do is just take that ending cash balance from week 1, and that would be your starting cash balance in week 2. And then of course, plus or minus any income and cash flow for that week. And so that's how you would track your ending cash balance week to week. And you'll see I have these items listed in red because the software that I use allows me to put in what's called a hot mark or a hot bucket, where if the cash flow drops under a certain amount, and in my case, I believe I have it as 20,000, then it'll show that amount in red to say that, hey, you're below your comfort level of ending cash balance. So you can make this as simple or as complicated as you need it to be for your own business. And then I like this because it gives a visual view of the Excel templates that we just viewed. This would be what the cash looks like week to week. Blue, we have the inflows. So that would be that 53,000 or that 68,000, I think it was, that 63,000 that we collected that first week. And then as you see for the next 3 weeks, no inflows, and then it shoots back up to the 63,000. And then of course the outflows week over week in orange. And then this gray line here shows the ups and downs of the cash balance as you're collecting and making payments. Tip number 4 would be to utilize accounting technology to collaborate with either your team members and definitely with your accountant. 2 softwares that I would recommend would be Xero, not Xerox, but Xero. They are a competitor of QuickBooks Online. And then the other would be QuickBooks Online, of course. I typically don't recommend the desktop version. If you are using the desktop version, great, but there are limitations on certain things that you can do with it, especially if you're looking to do cash flow projections. So utilizing that accounting technology and collaborating, one of the things that you can do is to use the bank feeds where you connect your accounting software directly to your bank account. So let's say if you're using Chase, Wells Fargo, Bank of America, you can actually set up a secured connection where QuickBooks or Xero goes and grabs those transactions from the bank for you on a daily basis or weekly basis, depending on the bank connection, so that you don't have to manually enter every single transaction into your accounting software. So utilizing this technology helps you automate some processes of your business accounting wise. And then that online accounting technology also allows for you to set up your chart of account in a way that will optimize your deductions. We know that every business is different, every industry is different. So my chart of accounts may not necessarily match your chart of accounts. You want something that's specific to your business and to your industry that, like I said, optimizes your deductions. So if things are typically deductible within your industry, you want to make sure that you have a chart of account that's dedicated to that type of expense. And and then one thing about using accounting technology is that you have real-time information at your fingertips, depending on how often the information is reviewed and updated will depend on how real the information is, how timely the information can be. And then lastly, connect your accounting to various apps. I mentioned that with the desktop application, you're very limited to some of the things you can do. With the online versions of accounting technology, you're able to connect to various apps. So if you're using something like Square Card Reader, you can connect your Square to your QuickBooks Online so that you're not doing double entry. You're not entering things in Square and then going back to enter things into QuickBooks Online. You can connect the two so that they're integrated and talking to each other. And then there's also various other apps that you can connect to these types of systems, like your CRM, if you're using things like that. Just it gives you a lot of flexibility to help scale your business if you are using an online version of an accounting system. And then number 5 would be to implement strategies to increase net profits. So we'll go over a few of those strategies now. So let's talk about increasing revenue. What are some things that we can do to increase revenue? Sounds simple, but it's the easiest. Raise your prices. Are you competitive enough? Are you within the industry norm for what type of product or service you're selling? Are you priced competitively compared to your competition? If not, raise your prices. Increase your customer base and sell more in quantity. Are you selling to a specific area, or are you kind of confined to a specific area? If you have an online business, then expand your reach. Even if you do have a brick and mortar business, perhaps expand your reach in your target or your focus to reach more customers so that you can sell more in quantity. Another option would be to add a new service or product. So even if you aren't raising your prices or you aren't expanding your reach, perhaps add a new service line to your existing customers. Okay, so increasing your revenue would be one way to increase your net profits. Another way to increase your net profits would be to decrease your expenses. First things first, trim the fat. Any non-essential expenses that does not grow revenue, consider cutting or reducing drastically. So what I would recommend is reviewing your profit and loss statement and going line by line, looking at each individual expense category to see if it's an expense that's driving your revenue up or an expense that's pretty much decreasing your net profits. So things like marketing is directly tied to your revenue, or should be directly tied to your revenue. So you may not want to cut your marketing expenses, but there are other types of expenses that you can look at and cut. And let's talk about some of that now. Price shopping, commoditized suppliers. So if you are buying supplies for your business, definitely price shop. Call up the vendors, see if they price match, or just see who's the cheaper vendor for that same type of supply. So if it's a very generic type of supplies and it doesn't matter who you get them from, then definitely price shop so that you're getting the best deal for your business. Invest in technology to cut cost. Yeah, I mean, it is an investment when you do go from a desktop environment to an online type of cloud environment, and just not only about the accounting software, but any other technology that you do use within your company, such as like your appointment taking apps, getting away from doing things pencil and paper or committing things to memory, but actually using technology that will help automate portions of your business. And then also utilize social media for marketing. So I don't want to say gone are the days, but we're not using too much door-to-door marketing the way that we used to because of social media. And we're seeing it now with the way that COVID-19 has affected our businesses, that everyone's now utilizing Zoom meetings, go-to meetings, or Google Hangouts or whatever, but utilizing technology to propel your business. And social media for marketing purposes is no exception. So getting the word out about your business and staying in the forefront in front of your customers, definitely you want to utilize social media for your marketing and cut back on some of the mailers. And then finally, if you do have staff members, take a look at their workload and your hours of operation. Are you being, I guess, productive, or are they being productive within that 9 to 5, Monday through Friday window? Is there an opportunity to reduce staff hours or reduce your hours of operation so that you're cutting back on some of those operating expenses? And then another way to increase your net profits would be to accelerate your cash collections. So the sooner you get paid, the sooner you can include that in your net profits if you're a cash basis collector. And one way to do this is to utilize online invoices. So instead of performing a service for your customer and then mailing out an invoice or emailing out an invoice, just use something that will allow your customer to click directly on that invoice and enter their credit card detail, their PayPal information, their bank information, without having to really pull out their checkbook and write a check and mail it to you. So utilize, again, technology to help you deliver those online invoices to your clients. And then if you're not doing this already, definitely consider this change for your business. Accept debit and credit card transactions. I know we like to stay away from it because of the fees that are associated with it, but just think of how soon you could have that cash flow in your hand if you are accepting debit and credit card transactions. Just think, as a customer, do you normally walk around with your checkbook? If so, great. But you do want to have the debit and the credit card option for faster payment collections for your customers. And then if you are using some type of automated platform, you can set up recurring payments for those customers who are subscription based. So if you do sell a product where it's the same price every month, you can set up automated payments or recurring payments to charge that customer $10 on the first of the month each month without you having to physically go and run that payment. And then lastly, use a mobile device for on-the-fly collections. So there's apps for everything. If you are utilizing Square or Cash App for Business or PayPal for Business, download the apps on your phone so that if you do have that sales transaction, and this is more so for the solopreneurs who are selling things in the field, or perhaps you're at a a vendor table and you're selling your product at some type of fair or whatever, you want to be able to have some type of mobile device where you can collect payments on the fly and email those receipts to your customers. So those are the 5 cash flow tips, and I'll tell you a little bit more about myself. I'm Audra Wilson Russell, owner of WATS CPA firm, and we are a virtual accounting firm that offers CFO advisory, outsourced accounting, and tax solutions, primarily to childcare providers. We are very passionate about helping our clients reach their business and financial goals. and some of the services we offer here under the CFO advisory umbrella. Of course, business advisory. So that's when we have those conversations about your goals and your targets, budgeting, cash flow forecasting, any advanced reporting once we do figure out what your goals and your targets are. And then, of course, the monthly accounting and bookkeeping and some quarterly options as well. And we also have some weekly bookkeeping options too. And then, of course, the compliance, such as the tax return and tax planning for individuals and businesses. And then we have various other services, such as helping you pay your bills online or helping you invoice your customers, and then also app advisory. So if you do utilize the online accounting platforms and you would like to connect any of those apps so that you can scale your business, that's one service that we do offer, is the app advisory. And then also payroll access. So if you have employees and you're looking for a payroll solution, that's something we can help you out with. And then cloud accounting migration. So if you are still on a desktop environment and would like to migrate onto something a little bit more automated, that's something we provide a service to. And then also training on the software. So if you needed help with doing the day-to-day within your QuickBooks Online or your Xero accounting software, we offer training on that as well. And then follow us on social media. We're everywhere. We have our Instagram, the LinkedIn, our YouTube channel, Twitter, and Facebook. We're at WATS CPA on all social media platforms. If you could please subscribe to the YouTube channel. It's fairly new. I have a few videos up there. Some of you may have seen some of the videos from the PPP loan forgiveness or just any of that stuff, any tax and accounting updates. You can find it there on the YouTube channel. So now at this time, I will take any questions from the audience. I'll go through the comments here.
Hi, Audra. Can I ask you to just stop sharing your screen for a quick second? Just so
Absolutely.
we can get back into gallery mode. Yeah, so Audra will definitely be taking some questions from any of you guys if you have them. In the meantime, I do have a couple while we wait for them to type. And please excuse me if they if you might have answered them, because you know sometimes when you're like writing down a question, you miss whatever was said right afterwards. So I have two generic ones, and then I have about three that are kind of more specific to each of your slides. So the first kind of generic one is, how often should you be meeting with your CPA as a small business owner?
I would say as a small business owner, at least quarterly, if not monthly.
Okay, perfect. And then what are some common mistakes that I should avoid with cash flow management?
Some common mistakes. Commingling your business and your personal would be one.
Yeah.
So definitely set things aside with your business and your personal so that you're not commingling. Another thing would be not to look into the future, not to look into those projections to see where you would land each month, where your ending cash balance would be. And then
just
as well as
hit that, right?
yeah, and then as well as looking into the future, not looking at the past to see, did you blow off any money? Are there any expenses that you are incurring that you could potentially trim?
Gotcha. Okay, so that kind of ties in, I guess, to my question. I think it was slide number 3, and you were talking about like how do you determine what you should pay yourself so that way you're not commingling, I guess, your business and your personal. Is it like a percentage? Is it just kind of based on each individual business? Like, what's the best kind of way to go about that?
So not a percentage, and it is going to be business specific as well as industry specific. So if you are an S corporation, you are required to take what's called a reasonable compensation, and the IRS doesn't define what reasonable is. So you kind of have to use some critical thinking when you're looking at your net profits and you're looking at your revenues and you're looking at what you would pay somebody else to perform that same service in your business. So kind of taking you out the picture, what would you pay a CEO to run your business?
Right.
And also taking into consideration, like I said, your net profits and your gross revenues. And then also a huge factor is looking at your distributions. Are you taking more out of your company in distributions than you are payroll? If you are, then you definitely want to sit down with your CPA, because if you are audited, then the IRS can relabel all of those distributions as payroll. And then now you have to pay back taxes on all the payroll that was reclassified. And so although there's a tax savings for S corporations because you have a balance of being able to take distributions, there's a thin line between the distribution / compensation, if you will, if you don't want the IRS to reclassify those distributions as wages.
Right. So when it comes to, I guess, paying yourself, does that fluctuate with what you're netting, or do you just set like your pay like you would for an employee for the whole year?
So you would do it for the whole year, and like I said, look at those factors to make sure that it's reasonable. So it's something that you can visit perhaps once a year,
Okay.
based on some of your historical net income and your historical sales, as well as what you foresee to collect in the future.
Okay, great. Thank you.
You're welcome.
Okay, and then so I guess this kind of ties into another question I had. I guess all my questions kind of revolve
Okay.
around each other. So from slide number 2, I think the title was "Understand Your Cash Flow." Sorry. What exactly makes it tricky when it comes to the distribution on the cash balance sheet? And that might have been the one that you may have answered as you were talking, but I was like writing it down because I didn't want to forget. Like, what exactly is it that makes it tricky about that?
Okay, not necessarily tricky, but if you don't understand the effect of it, then you can get lost as to why your ending cash balance doesn't match your net income. When you take distributions out of your company, it's not tax deductible. So that's not decreasing your net income. It's just you taking money out of your business for whatever reason. Maybe it's personal. Well, probably is personal if you're just taking distributions. If it's business, then it's an expense. So what's tricky about it is business owners will take a little bit at a time here and there, just, not even thinking going to the ATM, taking 500 this day, or transferring things to their personal account. Those are all distributions to the owner, and those distributions, they add up. And so let's say they take 20,000 over the entire year. Well, that's 20,000 worth of a $20,000 bucket that's not tax deductible. So now you're losing out the tax advantage if you had used that 20,000 on actual business expenses, as opposed to just taking it out of the business. So you take and you spend that money, it's gone, and so your ending cash balance is low, but your net income is still 20,000 more than you think it should be, if
Gotcha.
that
Okay.
makes
Yeah,
sense.
no, that does. That makes a lot of sense. Kind of cleared it up a little bit. Awesome. Okay, and then I have one last question. Sorry, I was like, I have all these little sticky notes as I was like listening.
Awesome.
So I'm assuming this goes to kind of slide number 4. It was about the accounting technology, and I'm assuming they're very accurate or pretty close to accurate. But is there any sort of follow up that you recommend, like manually to go in and check it, or there you don't really need to do that? Is that something the CPA handles? Is it something both of them look at just to make sure there's no glitches, or is it like a perfect system? I don't know.
So it's not perfect. It's garbage in, garbage out. So if you put garbage in, you're going to get garbage out. And a lot of the time, QuickBooks may suggest a category, or, hey, this is Office Depot. It should be supplies. And in some cases, they're right, but in other cases, they're not. And so if they're not familiar with your vendors and what type of expenses you incur for your business, then you you can pretty much jack up your accounting. And then when it comes time to file the tax return, everything is kind of, it needs to be cleaned up. So it's not 100% accurate based on the suggestions that they may make. So you still need to know and understand your type of business so that you are coding things correctly. Like I mentioned with the loan payments, if you don't understand the accounting behind it and how to record those loan payments correctly and how to apply it to the loan balance on the balance sheet, then you would definitely have some errors on your tax return come tax time. So what we recommend is based on the level of involvement you want us to have. So if we're doing things monthly or quarterly, we'll determine how often we look at things for you. Are we doing the full bookkeeping where we're coding things for you and you don't have to worry about that? And then we're doing the reconciliations to make sure that what we have in QuickBooks or Zero matches what's in your actual bank account, or are you doing that and then we're kind of reviewing what you did on a quarterly basis or when it comes time for tax time. But regardless of if you're hiring us to do it or if you're doing it, there needs to be that reconciliation piece so that you are reviewing what's in the books are accurate.
Right. Okay, great. Well, thank you.
You're welcome.
So if anybody else watching has any questions, please feel free to go ahead and type them in the Q&A. If not, Audra's information is going to be provided just in case you'd like to reach out one-on-one, or if maybe you have a more personal question that you don't want shared, on this webinar today. So I'm going to give you guys another minute or so. Audra, I'm just going to check our Facebook to see if anybody commented there. And after that, I think we'll be good to go.
Awesome. Thank you.
All right, so it looks like Facebook is all good to go. We did say, oh, you're responding. I was like, are you asking a question? All right, so that's it for today. Thank you so much for joining us. I really, really appreciated everything you did was so informative. I got some text messages from people saying that you were really good.
Awesome.
That's always nice to hear. Again, everybody, please know that this is going to be on the Chamber's Facebook page, the YouTube, and our webinars tab on the Chamber website. And Audra's actually going to have this video posted to her social medias as well. So thank you again for joining us. Thank you, FP&L, for sponsoring us. Please join us next week. Next Tuesday, we have our presentation, our webinars from FP&L doing a storm presentation. So with hurricane season being, here basically, it's going to be pretty informative and give some good tips. So thank you again, and we'll say goodbye.
Awesome. Thank you so much. Again, I appreciate the opportunity.